that candle, the closing price, we're going to annotate that. And then we're going to annotate the very next candle's opening price, which is here. What that's denoting is the distinction between where we closed for the 1 hour break and when we opened back up at 6 o'clock. So it's very little change. In fact, it's only one tick. So while it might not look that important, it goes completely past most people's eyes. But this is a new day gap opening, abbreviated by NDOG. New week opening gap is where we have the difference between where we closed on the previous week's Friday and the new Sunday's opening. New day opening gap is the difference between where we close at 5 p.m. New York local time and where we open at 6 p.m. New York local time. There may be a visual gap or difference between those two price points, something like this, where this is an actual liquidity void. We don't have that here. We see just the closing price, and then the next opening is here. So it's little to unchanged, but it's by one tick difference. Going over here, you can see, look at the bodies that are respecting it here. Look at the candle high here. Look at the low on that candle. A lot of sensitivity around there. Look at the close of this candle. Look at the open of this candle. Look at the high of this candle. Look at the high of that candle. Look at the high of that candle. The open and close on that candle. Lots of things occurring right there. So if you scrub forward, and I'm just going to keep that level in the center of the chart so that we can see when we get to, we're only going to go to about 4 o'clock, and then I'm going to close it. So here we are at new day opening gap. Okay, right in here. And the only thing I really highlighted here was the 7 o'clock time, where, like, if you're trading Forex, you can trade Forex around 7 o'clock to 9 o'clock in the morning, New York local time. If I suspect, this is where you're supposed to be taking notes, if I suspect that the market's going to be problematic for me, meaning that it's either going to be very hard to read, and I'm expecting that because of some news driver that would come the next day or later in the afternoon, like FOMC, I will adopt the 7 o'clock to 8:30 time window if I want to trade pre-market. So before 8:30 news driver comes, if I see something that I want to participate in, and I think that the news driver at 8:30, what I mean by news driver, any kind of report data, some kind of market medium impact or high impact news event that usually gets released around 8:30 New York local time. If I like the market structure that's in play at 7 o'clock going into 8:30, I have no fear of getting in a trade and using the 8:30 hour to roll right into my targets, which is what I showed this morning on Twitter. I went through the preamble of going through why I felt that the dollar index was likely to go higher, why I felt that the foreign currencies were likely to go lower and ES would go lower. I said that Forex and the equities like ES would seek sell side, meaning my bias was bearish. I prompted you to take a look at your chart for a new day opening gap. And for those individuals that are following on Twitter, all you have to do is go back to the time where I tweeted this morning asking if you've done what I've been teaching you to do. You would see the effects of price action here with the new day opening gap. Folks had already had it on their chart, and they had been sharing it, and they replied also with what they were showing. So this level here, That's the consequent encroachment of a previous new week opening gap. So right away, if you have just started following me, it's going to feel like, how can I keep up with this? And where do I start? Where do I begin? The easiest answer is this: just show up every day. Okay, just show up every day and everything will start to make sense over time. Don't demand that it's going to happen for you right away. Don't expect to be able to take trades right away and understand why you're doing it. I'm teaching you how to read price action on a different level. You're going to be looking at algorithmically. If you don't think that the price is responding to that small little separation between where we close on Friday, where we close on 5 p.m. and we open up at 6 p.m., you're in denial. The market ran aggressively right to that. Look at the bodies. Did we wick above it? Yes. Did the body stop at the low of it? Yes. Did the body open at the high of it? Yes. Was there any candle in here that went beyond the new day opening gap? Just the wick, no body. The body tells the story. The wicks do the damage. Market breaks lower, and this is consequent encroachment of the previous week, new week opening gap. NWOG is where we use the opening price on Sunday based on the difference between that and the previous week's Friday. They are static price levels. They're not hiding from you. They can't be manipulated after they've been given to you. Everyone sees the same price. It's not Forex where we don't have the same highs and lows. Everybody sees the exact same price. That's the advantage of trading futures. You can't be as manipulated as you would be if you were trading in Forex. For some of you that are kicking and screaming saying, I only want you to talk about Forex, ICT. I've come to learn about you as Forex, and now that I want to do it, you started talking about this. This is a better market. This is where I started. So when I took a step away from Forex, I went right back to my roots, which is this. That's why I told everybody before, if Forex ever became an issue, I know where I live. I can go right back to the commodity markets and futures, index futures, and bonds. Okay, so the things I'm teaching you when it comes to something like this is the same thing that you can apply to Forex. You can do the same thing with the price action and all the things, but I'm just teaching you very specific things that are directly related to this asset, to this particular market. It's advantageous for you to know these things because no one else knows them. No one else teaches it. How to use it, why it's implemented, what do we use it for, where's the advantage coming by knowing it. And once you have all those facets to this specific vehicle, index futures, it gives you there's no better way of describing it, is it's an insider's edge, because you're looking at the market way beyond the normal scope of the average investor, the average trader, the average day trader. They don't have these tools. You have them now, and everybody that's going to come to this channel and learn from me and on Twitter, you now have seen just in a week how influential these levels are, because the algorithm itself, okay, it's repricing back to these levels. It's offering what? Fair value. What is fair value? Fair value is the opportunity for market participants to trade at a level where the algorithm is deeming it not favored enough for enough of a length of time. In other words, it did not trade between a specific price range enough for participants to have the opportunity to trade. Does that mean that the algorithm is being nice to you as a retail trader? Is it being nice to me because we speculate? No. It's not for you. It's for a different class of trader that you're not going to meet. They're not on social media trying to sell courses. They're not doing teaching circuits. They didn't work in a pit. They don't work at Joe Schmo's bank down the end of the street where they can get a mortgage. They don't work at Goldman Sachs. They don't work at UBS. It's a completely different group. Their tools, their reference points are absolutely outside the scope of normal analysis concepts. Yes, it's technical science. Yes, it's highly precise. Do you honestly think they're going to trade and risk billions of dollars on Mickey Mouse analysis concepts? Absolutely not. They don't have trend lines that's diagonal. They don't look at moving average crossovers. There's nothing harmonic. There's nothing Elliott wave. There's no supply and demand. It's very specific, open, high, low, and close. That's it. And time. Time. When did this run occur? Going into what? The 7 o'clock hour. This whole run right here, right to that price point, set the stage for me to trust that I could find a setup before the 9:30 opening. And I had already anticipated that the 9:30 opening and throughout the session today would be lethargic, choppy, range bound. Can you trade in that? Absolutely, you can. I don't prefer to trade in those environments. Can I do it? Yes. Do I want to teach my students that are new to my analysis concepts and or speculation at all to trade in these environments? No. I teach you how to identify them and sit on your hands. It's important to know that because some of you still don't want to listen and you're complaining that you missed your trade based on what I was talking about today. By 2 seconds, you missed your trade, but good session otherwise. I can't like that comment on Twitter because what you're saying is you missed the opportunity to take a trade, which is exactly what I told you not to do. If you're trying to trade and follow along while I'm doing tape reading, you are going to get frustrated because you're going to be thinking I'm saying buy and sell when the only thing I'm teaching you is how to read and interpret what price is doing. In a couple months, you will be asked to push the button on your demo account. You got to let that time and necessity for that part of this development come its way in the natural order of things. But right now, you don't know anything. You have no idea what I'm talking about. You have no idea where I'm going with the lectures. No idea whatsoever. You have to be conditioned to see the things that's going to be repeating over and over again. But I need you to understand that the risks are elevated right now. It's difficult right now. And if you're trying to be proficient as a trader and push yourself in these environments right now, the only thing you're asking is to make it harder than it needs to be. That's what you're doing. So I want you to just keep that in mind when we're going forward with this mentorship this year. When I'm doing the live sessions, I'm giving you my time so that way you can understand the difference between a high probability condition and a low probability condition. Both can be traded, but one has a much better characteristic that it's easy to get in, you can trust where it's going to go, it's immediate gratification, and it quickly gets to your targets and you can wrap it up and go do whatever you want to do with the rest of the day. That's exactly what a trader would want to have. But because you're learning all this other retail stuff, you think that, the lifestyle is you got to be chained in front of the charts all day. You don't. You don't want to have that. You want to get your money, wham, bam, thank you, ma'am, out the door you go, and join back with the living. You go out and spend time with your family. So because I saw this morning, and it started to break down, I was watching the low of the previous week's new week opening gap. And again, I'm going to bring this down real quick. On your charts, you want to have 41.46 even, 41.34 and a quarter, which is this level here. And the difference between those two levels, exactly 50%, is this level right here, 41.40 and a quarter. So when we ran up to new day opening gap here, which again is, for your notes, the closing price at 5 p.m. and then the new opening price at 6 p.m. That hour gap that futures have every single day in the evening time in New York local time, that difference, whatever that range difference is, it could be several handles or it could be one tick, just like this. You want to have that annotated on your chart throughout the day. It's a reference point that the algorithm will refer back to. And I'll teach you more about that later on as we go. But it's very easy for me to drown you with all these things, and it's going to feel extremely complicated. And some of you probably already feel like this is just too much. Give me a moving average crossover. That's fine. If that's how you want to look at it, don't come back. But if you really want to know how these markets book, what makes them go up and down, where they stop, turn on a dime, and why they do it, you came to the right place, because you're not going to learn this anywhere else. But that new day opening gap, it ran to that quickly. Would you agree that that was a real quick run up into that? It's occurring at that 7 o'clock hour, New York local time. Your time on your TradingView charts while you're with me learning. I don't care what platform you use. You can be using something else. Trade of 8, Ninja Trader, TradeStation, whatever. It doesn't matter. While you're learning, okay, while you're learning with me, you should be implementing TradingView. Do everything you see me doing with TradingView. And yes, it might require you an additional step for transferring what you're doing here in TradingView with your trading platform. I leave that up to you. But it's essential that you do everything you see me and the rest of this group do with this one medium. That way you're never confused. Every candle identification that I present, you'll be able to track it immediately and see what it is that's going on in my commentary and on my analysis. So 7 o'clock in the morning to 8:30. If there's going to be a difficult time in trading, if I think that we're going to consolidate or we're in low probability conditions, that is the green light, okay? If you want a bat symbol, okay, the bat sign that goes up in the sky at nighttime. If you want the inside track, the little nudge from good old ICT, that means that I'm probably going to be taking something before 8:30. So you were prompted this morning to look for sell side in futures and in Forex. You were prompted to look for higher prices in dollar. I gave you the bias. I gave you the premise of what I was looking for. After I gave that, I engaged and did my own executions. I looked for the market to move away from the new day opening gap, which it did. I waited for it to trade down to the low of the previous week's new week opening gap. If you don't know what I'm saying, just write down the questions you're having, and I promise you, if you go over to Twitter and you ask it, that our community will gladly share the answers with you to bring you up to speed. We're not a bunch of goobers that sit around and are selfish. We want everybody to do well, and we feed off each other's energy. I feed off your energy. So if you have questions, just go over to my Twitter feed, just tweet to me, and people will see it, and they'll respond to you accordingly. If they're an asshole, I'll block them. So if you look, give me 1 second. If you look at the move away from the new week opening gaps low, we had displacement to the downside. As the market moved away from this level, do I need to be up here to get short? No. Did I need to sell short here? No. How about this one here? I could have got institutional order flow entry there. Yep, could have. Didn't do it. How about here? I could have traded back into that. Yep, didn't do it. I waited. I wanted to see it trade back to this key level, which is the previous week's new week opening gap. Then I waited for what? Displacement. I want to see it move sharply away from it. Then, because it did that, what happens? We have a fair value gap right here. So that fair value gap and the last up close candle at the new week opening gap. Which order blocks do you use, ICT? You're learning. There's multiple things about this. It's not just the last up close candle before the drop. That's no. That's not it. It's where you're at when that candle forms. And this new week opening gap, none of you were aware of it until I started teaching it. You're asking for the very specific video, okay? There will be a specific tutorial produced for it, but I want to show you it a few times, because every time I put something out new, invariably someone's going to say, this is nonsense, this is cherry picked or whatever. I'm letting you handle this. You're putting your hands all over this, watching it live. It literally just gyrates right back to these levels all the time, but you weren't aware of it. So yeah, I'm giving you the chance to have a laboratory experiment on your own, play with the toys, okay, and discover how systematic and routine these things exist over the course of a day and over the course of a trading week. But when we're looking for order blocks, that change in the state of delivery, which is what an order block is, it's not the candle. It has absolutely nothing to do with the candle. It has nothing to do with that candle. It's the change in the state of delivery. The market changes the state of delivery right here. Once it starts delivering sell side and you have a fair value gap, your eye goes right back to that opening price. It's going to trade up into the fair value gap. That's where you want to try to take your entry. You allow for the price to trade up to that level, because if it does, then you do another entry there as well. If you hold out the trade to the order block and don't put anything on inside the fair value gap, sometimes the order block will not be traded to. The fair value gap will be the only respected level, and then the market will run away without you. And that can be very frustrating, because if you demand absolute to the tick precision for all of your executions, you will miss moves. The market sometimes simply will not move exactly where you want it to go, or you'll be so picky about your entry, your limit order won't fill, and then it runs away. And then you have to use a lower, closer proximity entry to a price point that's lower than the key ideal entry points, like this one here. So the market moves again, small little movement into this candle's high. I like that. Added more. Go back and look at the Twitter example, okay? Because I shared this, I recorded it. It's there, and you can see my execution, the whole business. And then we had this fair value gap that formed. What kind of fair value gap is this? SIBI, S-I-B-I, sell side imbalance, buy side inefficiency. I noted real time. I removed it here for clarity. I wanted to see this remain open, and the market moved lower and attacked the sell side in here. All of this setting up for what? A move going into 8:30. The market consolidates going into the 8:30 hour, and I mentioned that we would see it drop aggressively, sharply, and into the 8:30 news hour. So the news event that came out, I don't even know what the data was. I couldn't tell you to save my life. If you offer me $1 billion cash to tell you what the data said for that report, I couldn't tell you. I don't ever give a shit. I don't care. I just expect the volatility that comes in the marketplace at that time. Once I know I'm looking for a run, then I'm expecting that 8:30 hour. If I know that the day that I'm about to trade is going to be a range-bound consolidation day or just choppy, I'm going to be doing my work between 7 o'clock and 8:30. And once the 8:30 news driver it kicks in and runs to the liquidity I'm looking for and fills my order, like you watch in the video I shared on Twitter, I'm done.